why. Joining me now to discuss, we bring back John Najarian, Fast Money contributor and co-founder of OptionsMonster.com, and David Goldman, former head of fixed income research at the Bank of America. You know, John Najarian, as our own John Kudlow mentioned a moment ago, and I had the economist John Riding do the math for me. If we went back in constant dollars, the price of gold would have to hit $2,400 to equal where it was in 1980. So, John, are we going to go over $2,000 in gold? Is that where this story is leading?
It's absolutely leading there, Larry. There's a whole bunch of reasons. You and Kildoff just went over a bunch of them. With governments running the printing press, that's a big reason, of course. But as a percentage of global financial assets, gold peaked out at about 6%. In 1968. It's under 1% right now. So I would say it is under-owned despite the furious way that people have been accumulating it over the last little bit. And as it becomes more and more dear and the price goes higher and higher, as you said, silver is one of the areas where we see the biggest concentration of the smaller traders flocking into silver in a big way.
I mean, I say silver is almost cheap gold, David Goldman, because silver has monetary properties just like gold. There's a rejection of the dollar. There's a rejection of confidence in Mr. Bernanke, David Goldman. What's so mysterious about this? The rallies will continue, or do you have a different take?
Remember, Larry, that in 1980, when gold was last at a peak, Russians had just invaded Afghanistan, the Jimmy Carter administration was flailing with the hostages in Iran. People thought NATO would break up. The U.S. role in the world looked like it would collapse, and the dollar's reserve status ultimately hinges on American political power. Now you have an administration just as feckless as Jimmy Carter. We throw our friends like Mubarak under the bus. No one's asking Assad, who's an enemy, terrorist supporter, to leave. We look stupid and weak. So we have conditions like 1980. People ask, why you should own an asset at 1460, 50% above the marginal cost of production? Isn't that a bubble? Well, it is a bubble, but so is government debt, and you don't know which is going to pop first. So you should have 10% of your assets in gold. Silver is a more difficult equation because ultimately if the dollar reserve currency collapses, the rest of the world will have to set a price for gold. That will be a political issue, and I think gold will be more of a political vehicle in that case than silver. So I think gold as a long-term hedge has that advantage.
John, let me ask you this. I know gold and silver have been running for quite some time, but it seems like in the last week or two we've had a renewed move up in both of those metals. Is there something new at the margin? Is it the government shutdown fears? Was it Bernanke's disappointing speech in Q&A on Monday? Is there a new event triggering this last move which has gotten so much attention?
There was certainly a lot of fear, Larry, about the situation in Japan, the dire situation at Fukushima, and the fear that was centered around that. As that died down, it was pretty clear in the last week or so, as you say, that people were aggressively accumulating upside bets. I call them call options, of course, for silver, for instance. And today, silver, the ETF, traded better than 250,000 contracts. That's huge for that. And they were over 80% of those were call options being bought all the way up to about the 48 strike in May. That doesn't mean necessarily that people think it'll be 48. This is a stock that, or an ETF that closed at 38.60 or so. But a push higher, a push to 40, means those options could double like that.